Today, we're looking at whether the dollar wrecking ball is back in play. And then we're going to move on to what's currently changed in the relationship between bonds and stocks. And the trading takeout today is, why does it pay so much to focus on the biggest relative changes? But before we get into it, make sure you like and subscribe to this channel just so that I can pop up in your feed every day so that you can maintain your trading edge. This chart should absolutely be imprinted on your heads now because we've been going on about it for about 3 months. This is the euro dollar chart on the weekly, 15-year trend line, 200 daily moving average. We've literally just formed a massive head and shoulders onto that 15-year trend line as well. And we're trading below, or we're trading well through actually the 200 daily moving average. I don't like technical patterns on smaller timeframes because I don't feel that the smaller timeframes actually support the broader macro backdrop of the requirement for the euro to be structurally weak. I don't think it supports that. So looking at it on the longer term timeframes gives you a much better edge slash, probability, if you like. So what we're looking at here really is a deterioration in German data heavily. We're looking at the dollar come back into resurgence, and I'm going to get onto the specifics with regards to the dollar just in a sec. And also we're looking at rest of the world degradation too. The euro was used heavily as a carry trade for a long time, so now that is being unwound heavily. And the way that I think of things moving forward is, I mentioned previously that the euro has a requirement to be structurally weak from here on in. It's destined to support German and Western European mercantilism. It has to. Otherwise, the structure just absolutely deteriorates and blows up. But there is the geopolitical side as well, which supports that, which is a lot of uncertainty. And what we know from markets is that when things are very uncertain, markets don't like that. Markets love certainty. So if we are experiencing uncertainty, then the currency is going to face high volatility and usually downside shocks. Now, if we're looking at the dollar side of things, this is something that I created a couple of years ago. It kind of visualizes this relationship quite simply. So when does the dollar depreciate? Well, the dollar depreciates really when yield is to be found in risk assets. Okay, so when stocks are doing fantastically well, but well globally, not just in the US, what you tend to find is that if it's just doing well in the US, then the dollar increases, which is sort of what we're seeing now. So you see a relationship where the dollar and stocks at the same time are increasing. It tends to only last for shortish periods though. But at times like this, when US growth is extremely strong, we just got a revision at 5.2%. You're really going to see investors want to pile into that, especially when the rest of the world isn't doing so good. They're going to try and make use of that higher yield and also, try and get some, I guess, yield from risk assets as well, which is why, too, we are seeing stocks still remain slightly higher. Now, the key thing for me with regards to the euro chart here is if we do go down onto the daily, we've got some relatively, identifiable places to look in terms of resistance. So if we're looking just from a purely technical perspective, you've got all up here. I don't think we test up there, but it's good to mention anyway, which is about 1.1. And then shorter term, you've got, the 200 daily moving average, which is just at 1.08. Let's call it 1.0825, say. And then there as well in the shorter term, you've got that level 2. So there's a little broken low there and where the 200 daily is. I don't necessarily look at that, but as a place to do business where others might be looking at it, probably quite a nice place to focus on. But then you've got to make sure that your risk is managed from a volatility perspective and not just from a price perspective. So, for example, you might want to look at what the daily or weekly expected move is and then throw a stop above that price, whatever it might be, from where this level is. So let's say the daily expected move in the euro is 0.5%, which is not. I think it's about 0.35%. You'd want to shove a stop about 30 ticks to 40 ticks higher. I think the volatility might have picked up, so I might be misquoting that. But you might want to have, if you're looking at just a smaller intra-week move, a stop that might be 30 to 50 ticks higher, maybe, depending on where your entry is. So yes, that's the way I'd look at this market. Still think very much it should just slide to the downside. Key is obviously where buyers stepped in here at this big low. So targets for pain, roughly here. Preferably there, actually, where the move started to shift up. But that's my view on the euro. German data still coming out really, really poorly. With that basis, you'd expect that the ECB has to cut sooner rather than later, and the market is currently pricing cuts for March, so way before any other central bank. Most of the central banks pricing June to August. I think the BOE is August at the moment. So yeah, not looking good for Europe, not looking good for the euro. Maybe they see some sort of resolve or structural changes. We'll see, but yeah, the euro is not in a good place. So bonds and stocks, what has changed? Well, it's quite nuanced, really. It is sort of linked to what I was talking about before with regards to the dollar smile as well. Excuse me. However, it is also quite different too, because we're talking about different asset class. But what I want you to focus on really is this little change here. Now, what you tend to think happens when yields are falling is that should be supportive of stocks. What we've seen since the middle of November is that that's not exactly the case. What we're actually seeing is a deterioration in the quality, I guess, of movement occurring in stocks. And what I mean by that is, as the yields have collapsed further, this is the 10-year yield here, we've had a big hold up, which you can see just here. Big old hold up in the stock price. When it started actually, decelerating to the downside, we saw all of this really strong buy-in. We saw pretty strong buy-in even here. But then, since then, it's just held up, and we've had broader moves, broader ranges, but just flat. So you can see here, we closed higher after opening, relatively well, but then we opened again the next day really quite low. Same here actually for yesterday's trade. We've basically done a bearish engulfing there. So things aren't looking great in terms of that. And the dynamic that I think really has changed here is perhaps there is now becoming some greater fear perhaps of the unemployment situation. Yellen, for example, saying that the people who were betting against a soft landing, which is basically the economy being able to sustain the higher interest rates, not be affected by unemployment, debt burden, etc., etc. She said last week that they're eating their words, the people that were betting against this. And that's a dangerous game to play, very, very dangerous game to play, considering that rates are higher and markets do tend to be affected by higher rates. And I think, the way that the market perhaps has responded to that is with a little bit of, okay, well, shall we use that as a contrarian indicator? Perhaps that's, what my thoughts are. But even if you look at this market technically, this is the S&P 500, obviously. Even if you look at this technically, we can see that we're back at a previous high where it was, a short-term cycle high. And that's where we fell down to 4,100, let's say, from back in, July. So we're seeing a very similar behavior here occur as well, actually. We are seeing a similar behavior here occur. So I would be concerned that the risk to reward is no longer with the upside in equities. I would be concerned at that, especially with the way the dollar's behaving, as we just described. Dollar up tends to mean that risk is off a little bit. And especially with how these ranges here have behaved as well. It's very, very similar to back in June. So I would keep an eye out for that. Perhaps if you want to be looking at longer term buying opportunities, you could say that the 200 daily, again, is a fantastic systematic way to buy equities. That is a strong probabilistic place to be thinking of, okay, well, if I'm looking for a bounce, and I think if the conditions facilitate a bounce, then that's a good place to get long. Flip side of that, of course, if it slices through on high volume, that's when you start saying, oh no. But yeah, that's the way that I'm looking at it. I think we have a hold up here. I think something has changed, whether it is the narrative coming out of the Treasury, Janet Yellen, or if it's simply that this move is slightly exhausted going into year end. Dollar can definitely factor in here as well. But to put it simply, I think the probability is now lower rather than much higher. Today's trading takeout is why you need to pay attention to the biggest relative moves, especially in major asset classes. Now, in front of you, we've got the Japanese 10-year bond yield. And this is really, really important purely from the perspective of the fact that yield curve control is meant to be fixed, but we've just seen one of the largest rises in the Japanese 10-year yield ever, especially with where US equities are as well. Is this significant? Who knows? But these are things that you add into your view on how markets are working. You look at the most relative moves and see, okay, is that vital in my view of the market? And can this fit into a new piece of the jigsaw to be able to determine which way a certain asset class is going? How does it then interact with something that I'm more familiar with? And is it going to cause other people to interact with that asset class as well? These are the questions that you have to be asking, because it pays to look at these relative moves that will influence markets in some way or another.